whatever your baseline is, probably treasuries, 2-year notes or 5-year notes or whatever, they will come down a lot. Not right away. We may still be a month or two away on this, but they'll come down a lot. The interest rates are a lagging indicator. Everyone's like, well, how could interest rates be, going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. But the stock market is saying, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo that the Fed will figure that out before they get to 5.25, before they raise rates in May, maybe even March. Maybe they're done. And because of a recession, this is the soft landing Goldilocks scenario, where the market's right, the Fed's wrong, but the Fed will realize that the market's actually right and cut rates, and if you're going to cut rates, buy stocks. That's Wall Street always ends every analysis with buy stocks. So here we see Wall Street in real time kind of bidding up tech stocks because the Fed's going to pivot and cut rates. When in fact, Powell's thinking, no, that's not happening until 2024. So that's what the Fed thinks is happening. The market thinks that Powell is over-tightening, that inflation will come down faster, and the pivot will happen sooner. And that's why we've seen a little bit of a rally in stocks recently. So you have the Fed narrative, that's plan A. You have the market's version of what the Fed's actually doing, which is plan B. My estimate is that they're already past the terminal rate. They don't know it. They don't think so, but they are. And as I said, inflation is going to come down a lot faster than anyone expects. I talked about how the Fed is blundering because they're raising rates too high, too fast, et cetera, and they are. But the Fed has always said, we don't worry about inflation. We don't like it, but we know how to get rid of it. We just raise rates, and maybe they got to raise them longer and further than people expect, and maybe it's painful. There are costs involved, but they can kill inflation just by raising rates. They don't know how to stop deflation. I mean, how do you stop deflation? You can't raise rates. That'll make it worse. You can go to zero, but that doesn't, once you're at zero, you're at zero. QE doesn't work, by the way. It's been tried to the tune of like $9 trillion, but the empirical evidence is that it's just, they do QE by buying bonds from the banks, and the banks take the money and give it back to the Fed as excess reserves. That money never goes to the economy. What good does that do? And the answer is it doesn't do any good. It's a triple, greatest bubble of all time, times 3, in the sense that it's real estate, stocks, and other asset classes. So I do, that is my view, but it's shared by a number of other analysts. If all that's happening and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last, how are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. I mean, nobody can afford our stuff, and we're not buying anybody else's stuff. So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all? They're two different things. The global economy is the big topic. That's what we all care about most. But financial markets can come up with their own narratives and go their own way, at least for a while. So you have to, they're not in sync. They will be in sync eventually, but not always right away. A lot of times the financial markets get ahead of themselves, and then they wake up to reality and they crash, correct down. But in terms of the global economy, I think your use of the word global is very much on point, because it's often the case that, you look around the world, you've got the United States, or, North America, if you want to throw in Canada, you've got the EU, you've got China, you've got Japan, they're all important economies. but they can kind of be in different parts of the business cycle. And it's not unusual for one part to be in recession, but another part of the world is like doing better. So then they use the phrase locomotive theory. The locomotive is going to pull us all out of the ditch, and we'll get going. So it's not unusual to have recessions in the United States or Europe or particular countries in Europe or Japan. I mean, Japan's had 9 recessions since 1989. I mean, 9. I consider that one long 30-year depression. That's a debate for another day, but that's how I would describe Japan. But it usually, one's not doing so well and another part of the world's doing better. That's not the case. What is happening right now, I see it, but there's an awful lot of data to back it up, is that we are going into, or may already be in, a global recession. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession based on a lot of factors, some of which we've spoken about. Now, the other half of your question, which is important to listeners, is what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got 3 Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling 3 different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So the Fed story kind of goes like this. The Fed, forecasting what the Fed's going to do is the easiest thing I do. It's not because I have a crystal ball or I'm smarter than anyone else. The Fed actually tells you. All you have to do is listen and believe them. Now, a lot of people don't listen, or they listen like, oh, the Fed will never do that. They will. They actually mean it. Japan had the famous lost decade. Well, the lost decade was 20 years ago. Started in 1990 through 2000. Japan's now almost at the end of their 3rd lost decade. The United States has had a lost decade from 2007. We're probably, if something doesn't change, either in terms of policy or a collapse, something gets worse. But absent that, we're going to remain in this kind of punk 2% growth as far as the eye can see. People say, oh, well, second quarter GDP, Atlanta Fed predicts, 4.5%. Yeah, but we've had 4 and 5% quarters in the last 9 years. They don't last. You get these spikes, you get a real good, 4% print, and then the next quarter is 2%. The one after that is 0.5 or maybe even a negative quarter. So the headwinds, demographic, technological, productivity, psychological, etc., haven't changed, and there's no reason to expect they'll change. So you can't understand debt in isolation. You have to understand debt relative to income. And that debt to GDP ratio, which is something I spent a lot of time looking at, the GDP is kind of chugging along, not going up very much, but the debt's going like this. The debt to GDP ratio is getting worse. I write books, and I also write several financial newsletters, so I'm thinking about topics all the time. And there's always one. Usually you say, well, all right, this war in Ukraine is a really big deal, got to cover that. Or financial implosion in China, really big deal, got to cover that. Or what's going on in the U.S. and other topics. I could give you a long list. Maybe the end of the dollar's role as a global reserve currency, et cetera. The difficulty now, they're all going on at once. Any one of those topics would, fill a newsletter or be a big topic, a heavy lift, but they're all going on at once. And number 2, they're not unrelated. There are all kinds of correlations. The breakdown and collapse of the global supply chain, which preceded COVID. A lot of people say, well, COVID came along. Of course, it messed up the supply chain. In my new book, Sold Out, I've got very, very good documentation that shows the supply chain was breaking down before COVID. Now, of course, COVID made it worse. Yes. And the war in Ukraine made it worse yet. Yes. But this really started with Trump's trade war in 2018. So, that, like I said, there's a thread that runs through all these things. So, when you ask me that, I'm thinking, well, you want to talk about China, Ukraine, supply chain, they're all a big deal. The war in Ukraine is the most important because it's highly, highly significant economically and strategically. But of course, it's a human tragedy going with it. If Chinese real estate implodes, okay, there's some hardship here and there, but it's not like people being killed or maimed or forced into refugee status. And that is part of what's going on in Ukraine. So that's probably the biggest single one, but I wouldn't miss the fact that all these things are going on at once. It's interesting because I do have kind of an international following, but there are certain pockets. I mean, there are certain countries where, there's interest in what I do, or my books are published in that language, et cetera. So I have a good German following, and of course the Germans want to know what's going on with energy, Japanese followings. The number one question, of course, everyone's concerned about inflation, but there's a big backstory there. But I always say when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your, ability to feed your family or keep a roof over your head. So people get inflation. It's one of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And as recently as a few months ago, I would say, yeah, I think so. You can see it coming. And there's data. I never make statements like that without supporting it. There's a lot of whistling past the graveyard. I mean, the stock market is still greatly overpriced. There's still, the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, and there's institutional support. There's momentum trading. Of course, 95% of the trading is by robots. So all that's going on. So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on. I mean, that is my expectation. I have my own models and I look at it closely. But if you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions, and they're saying the same thing. So, so every now and then someone will throw some statistic at me and I go, how long is your time series? And I go, we took it back 5 years. I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's the greatest bubble of all time, real estate, stocks, and other asset classes. So, I do, that is my view, but it's shared by a number of other analysts. And again, you have to remind people, 1929, everyone's like, October, I think 18th or 19th. It was late October 1929. The stock market fell 22% in 2 days. It wasn't one day. It was, it was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. I mean, that was the beginning of the crash. This Dow Jones fell 82%. From top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years, but that fell 82%, and that happens. So we're down. Nasdaq's down, bounced back a little bit, down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect. The soft landing is a myth. There's not going to be a soft landing. It's going to be a hard landing. That's not priced into markets. The markets are pricing in a soft landing because they're not pricing in a really hard landing. So you have what's called cost push inflation. That's where, supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or, kind of do without. We are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like, here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food. You got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food because you're moving it by truck, et cetera. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that cost push inflation, and you see that in inflationary expectations and inverted yield curves. And I'll come back to that because that's a really big deal. If you thought inflation was going to run away, as it did in the 70s, yield curves would be steeply sloping. and people would be in a frenzy to buy stuff. They're not, and the yield curves are not sloping or upward sloping. They're inverted. They're going down. That tells you that, and we also see this inflationary expectations. Inflationary expectations don't drive inflation here and now. What does is inflation here and now can feed on itself. Inflationary expectations don't drive it, but they tell you a lot. They're information rich. They tell you a lot about what people expect. What the yield curve is telling us, what inflationary expectations are telling us, and other factors are telling us is that, yeah, there's inflation now, but the Fed's going to kill it, and they're going to kill it by destroying demand and throwing us into a recession. And here's where it gets interesting, because you could flip from this kind of inflation to disinflation or even deflation very quickly. And people are definitely not prepared for that. Well, I'm sorry, I shouldn't say that. Kind of everyday consumers are prepared for it. I'm not sure Wall Street and mainstream economists and policymakers are prepared for it. They're just extrapolating the inflation, saying, well, the Fed's going to kill it. Yeah, they might kill it, but at a price, at a very steep price, and consumers are really bracing for that. So the soft landing is a myth. There's not going to be a soft landing. It's going to be a hard landing, but that's not priced into markets. The markets are kind of pricing in a squishy landing or a soft landing or from the runways. They're not pricing in a really hard landing, and that is what we're going to get. It's going to get worse. Inflation's here to stay. Commodities are going to boom. Oil prices are going to soar. Bonds are going to crash. And gold has been in a very funny situation, which is the following. Normally, you say, well, if there's inflation coming, why isn't the price of gold going to the moon? And why on earth would gold prices go up if there were deflation or disinflation? The answer is that you have to look at the yield to maturity on the 10-year Treasury note. That's our benchmark security. A lot of people look at LIBOR, but I'm like, no, if you're making investment decisions, you're buying a house, you're doing capital investing, these are all 5, 10, sometimes 20-year decisions. The 10-year note is the right benchmark for those large, long-term investments. Well, that's an alternative place to put money. You can buy gold, you can buy a 10-year Treasury note. So what's been true since last summer is as the yield to maturity on the 10-year note goes up, that strengthens the dollar, and gold prices have gone down because the dollar price of gold is just another cross rate, just another cross exchange rate. So a stronger dollar means a lower dollar price for gold. But if the yield to maturity in the 10-year note goes down, then that weakens the dollar, and the dollar price of gold goes up because a weaker dollar means a higher dollar price for gold. So curiously, the price of gold is being driven not by inflation in the abstract, but by the strength of the dollar, which is reciprocal to the interest rate on the 10-year Treasury notes. But here's what has changed. I talk about gold bull markets and gold bear markets, and I start my analysis in 1971, and I don't have to go through all that data, but that's how I think about it. And you're like, well, Jim, why 1971? Why not before that? And of course, 1971, it was when Nixon stopped redeeming dollars for gold. Americans couldn't even own gold in 1971. It was contraband. It was like drugs or machine guns or something. But foreign trading partners could redeem dollars for gold up until 1971. And then Nixon said no more. And then that was the final decoupling. But prior to that, gold was actually money. In other words, under Bretton Woods, gold was pegged at $35 an ounce. Prior to Bretton Woods, it was pegged at $20.67 an ounce. So going back to the 1920s or earlier, through most of the 19th century. For the United States in sterling, I think it was $4.75. It could be off a little bit on that, but four pounds and change. And as late as World War I, say 1913, if you were a Brit and you were getting on the steamer from London to, at the time Bombay, today Mumbai, you took a purse of British sovereigns. The British sovereign is about 8 grams, a little bit less. It's not an ounce; it's a quarter ounce, because an ounce is almost too much. Even today, what are you going to do with a 1 ounce coin that's worth almost $2,000? You're not going to use that to buy a pack of gum. But in the day, there was the quarter ounce, which today would be, like a $500 bill. So it's still a significant amount of money. But you could get on the steamer in Southampton and get off in Bombay at the time, and it was money good. You could take that British sovereign and spend it anywhere. And same thing in Singapore and Hong Kong and Japan or all around the world. So gold was actually money. So it wasn't a question of, what's the exchange rate? It was, the gold was the money, and people thought about it by weight. They said, a sovereign, that's 8 grams of gold. So that's worth, that'll get you whatever. So, and that was true throughout history. And so it's really only since 1971, when we decoupled completely in terms of an exchange rate, that you have to think about, well, what's the dollar price of gold? Because it's not fixed. But okay, well, what happened to the memory? What happened to the 3,000 years I just talked about? Well, the answer is it happened in stages, and it actually took about 75 years. So it began in 1914. 1914 was the outbreak of World War I. Everybody needed gold. There was a run on gold, and countries needed gold because they knew they would need gold to pay for the war, to try to win the war. Well, it didn't matter if you're Germany, UK, or whoever. And remember, the United States was neutral. The United States did not get in the war until 1917. The war started in 1914. So for those first 2.5 years, New York was a money center to all of Europe, to all the belligerents. So everyone scrambled for gold. So if you were a citizen, they asked you to bring your gold to the bank, and they gave you paper money. But people did it out of a patriotic. It's existential. War is not a normal market. If you lose the war, you got bigger problems than your gold. And so people put the gold in the banks. What did the banks do? They melted it down and made 400-ounce bars. And they said, don't worry, your money's backed by the gold, but keep using that paper money, but it's redeemable for gold. But oh, by the way, they're 400-ounce bars. Nobody walks around with a 400-ounce bar in her purse. I'm sure you've seen one, and I have as well. They're heavy. They weigh about 35 pounds. You don't walk around with them. So all of a sudden, the gold was still there, and the paper money was backed by gold in theory, but the gold had disappeared into the banks. That's step one. Step two, and this happened in the 1930s, the central banks took the gold from the commercial banks. So first, the commercial banks took the gold from the people. Then the central banks took the gold from the commercial banks, and the Federal Reserve System told all the banks, hey, send your gold to the regional Federal Reserve Bank. And of course, most of it went to the Federal Reserve Bank in New York. So now it's not even in the banks anymore, right? But you're still walking around thinking your paper money is somehow attached to gold. But people haven't seen gold for a while, unless you're a collector. Step three, the United States Treasury and the finance ministries took it from the central bank. In 1934, the United States Treasury seized the gold of the Federal Reserve System. Bearing in mind, the Federal Reserve System is privately owned. And they gave them a gold certificate. And you go to the Federal Reserve System website today and hunt around a little bit on the links and find the balance sheet of the Federal Reserve, and it's there. And look in the assets. And the first line item is gold certificate, and it's valued at $11 billion. But that's because they value the gold at $42 an ounce. And I've revalued it, the answer is that today's market, that 11 billion is actually worth 470 billion. So the Fed has a hidden asset of 450 odd billion that's not on the balance sheet, represented by a gold certificate. But it's not the gold. The Treasury has the gold. And by the way, where do we keep our gold? I'm talking about the United States. The Treasury owns the gold. The Fed has a paper certificate. The gold is on two Army bases, West Point and Fort Knox. So I would say the Army has the gold. Gold has gone from citizens walking around having it in your purse, to commercial banks, to central banks, to finance ministries, held on an Army base. It's still there. The gold didn't disappear, but nobody talks about it, and everyone pretends it's not money. But of course it's money. But meanwhile, what's happened to the civilian population, the citizens? We stopped talking about it. We stopped saying it. We stopped learning about it. I remind people, just showing my age, but I got a graduate degree in international economics, and I was class of 74. But that was the year the IMF demonetized gold. But I was the last class that was taught gold in an academic setting as a monetary asset. If you're younger than I am and you know anything about gold, you're either self-taught or you went to mining college, because they just stopped teaching it. So now we have two generations of scholars who never learned a thing about gold. So they hid it, they took it, they buried it, they stopped teaching it, they stopped talking about it, and they pretended it's not there. Meanwhile, it is there. And Russia is a good example of someone who takes it seriously. In the US, we still have our 8,000 tons, 8,133 tons. We haven't given it away. We haven't sold any gold since 1980, by the way. We got the British to do it. We got everyone else to do our dirty work. The British sold more than half, no, seriously, the British sold more than half their gold. The Swiss sold 1,000 tons. The IMF sold 400 tons in 2010. That was the last significant sale by a monetary institution. Australia sold most of theirs. Canada sold most of theirs. If I were one of these other countries, I would say to the U.S., hey, why don't you sell some of your gold? But the U.S. doesn't. We haven't sold it an ounce since 1980. Just at a very high level, I would say that there are a lot of difficulties, a lot of challenges. We'll talk about all of them in detail. You know, people put words in your mouth and kind of get the reputation as this doom and gloom guy. You know, Jim Rickards is always talking about the end of the world, which I don't. I never use that expression. But I make the point that, yeah, despite the difficulties, we don't have to be victims. We're not helpless. We don't have to curl up in a ball. The key is to see it coming. If you can see things coming, you can deal with them accordingly. You can get through them, not only preserve wealth, but actually make money. I always point out the example of Hugo Stinnes, and people go, who's that? He was an industrialist in Weimar, Germany in the early 1920s, and he could see the hyperinflation coming long before the middle class, long before anybody else. He went out and borrowed an enormous amount of Reichsmarks, that was the currency at the time, and just bought industrial assets, coal mines, vessels, natural resources, etc. So here comes the hyperinflation. He gives it a little time. He pays back his debts. I would say pennies on the dollar, like a millionth of a penny on the dollar, in other words. But he paid it back. They were sweeping the money down the sewers, but he paid back his debts and kept all the assets. And he became the richest man in Germany. And my German's not very good, but his nickname was the Inflationskönig, which means the inflation king. So there are other stories like it, Joseph Kennedy in the 1929 crash. But here's a guy who lived through the greatest hyperinflation of any modern industrial economy and ended up as the richest man in Germany because he saw it coming and made the right move. So again, we're not helpless. We can do things about it. But the key to empowerment, as I say, is to see it coming. That's where the analysis comes in. And you're like, gee, Jim, are you smarter than everybody else? Of course not. There are a lot of big brains around, but people have flawed models. There's a lot of behavioral psychology behind it, the confirmation bias or believing the future will resemble the past, which it usually does not. And so if you're going to stick to those models, you're going to get really bad results. It's hard to think of an institution that has a worse forecasting record than the Federal Reserve, the U.S. Federal Reserve, with the possible exception of the IMF. They're both pretty bad. I mean, you could almost take the Fed forecast, do the opposite, and be just fine. There's more to it than that, but they just stick to these really bad models. But if you understand how the economy really works, if you understand it's a complex dynamic system, all I've done is I've taken complexity theory, which has been around for a while. I mean, you can say 13 billion years because the Big Bang was the ultimate complex dynamic paradigm shift or phase transition. But the science of complexity, understood in mathematical terms, really dates to the early 60s. But it's been used very successfully in physics. It has a lot of applications. All I did was bring it over to capital markets. I looked at capital markets and said, wait a second, here's one of the most complex dynamic systems you can picture. And then there's nothing more complex than the human brain. So you're putting humans on top of capital markets. You've got complexity squared or some exponent. And those models work brilliantly. But try getting anyone to understand it or do that work is difficult. But again, the point is, if you have the right models, and I would include behavioral psychology, a good dose of history, complexity theory, and a few other branches of applied mathematics, you can get very good results. But if you stick to, the Phillips curve and non-accelerating inflation, unemployment rate, and a lot of other nonsense the Fed uses, you're gonna get it wrong. Does the future resemble the past? With some probability, some degree of distribution probability. Not always. I mean, and maybe less frequently now than ever. And they also assume that prices move continuously. Prices go up and down, of course, but markets don't move continuously. Or if they do, it's when you don't care. When you do care, they just gap. They gap down or they gap up. You miss it, you blink, and it's at a completely different level. It's been repriced. Now, you can still get in and out, but you've either made a lot of money or lost a lot of money, in the blink of an eye. So when you take those characteristics, and this is how I started deconstructing it, if you will, and said, well, look, markets are not efficient. That's nonsense. They don't move continuously and slowly. They gap up and they gap down. And if you're not ready for that, you've missed the boat. Nothing's risk-free. So why don't we start there? When I started identifying those factors that, in my view, were incorrectly applied, and you say, well, what looks like that? Well, the answer is a complex dynamic system. A system that produces hurricanes and tornadoes and lightning bolts and power outages and earthquakes and tsunamis. Those are all examples of the results of complex dynamic systems. An earthquake doesn't sneak up on you. It it just, the ground falls out from under you instantly. And that's what happens in markets. So then I said, well, maybe that's a better model. Of course, it is. Things evolve all the time. Another tool, intellectual tool, applied mathematical tool, uses Bayes' theorem without getting too much in the weeds. And I learned Bayes' theorem at the CIA because I always say, if you have all the facts, a smart high school kid can solve the problem. The intelligence agencies and others, and people in capital markets, have to solve problems when you don't have all the facts. But you have no choice. In national security or defense, it's literally life or death. On Wall Street, it could be your fortune or your client's fortune. So you don't have the luxury of just throwing up your hands and say, well, I'm going to wait till I get more facts. That's what Janet Yellen did, but that doesn't work in the real world. She's kind of detached from that. So how do you solve problems when you don't have all the facts you need to really solve the problem, and you know it, but you have to deal with it anyway because it's coming at you? Well, Bayes' theorem says assign an initial probability, a priori assumption. Just not make it up, but do the best you can, recognizing that you're going to fall short, that you've got missing pieces in the puzzle, if you want to put it that way. And if you have no facts at all, and it's a binary outcome, give it 50-50. It's like, it's not quite 50-50, but red or black on a roulette table, it's a little less than 50-50. It was close enough. You say, it's either going to be red or black, don't know which, I'm going to give it a 50-50. And then what you do, this is what statisticians hate, you update it based on subsequent facts. As new facts come in, you put them back in the model, you update it, and what you'll discover is that your probability either goes up or down. Well, if it goes down more than a certain amount, you discard it. You say, well, that's wrong, I just do it again. But if it goes up, what you're doing is making it more and more likely that your assumption was true. And so eventually you can get up to the 80-90% level. And that's not 100%, but it's pretty darn good. But there's a tension, which is, okay, as you're updating, and this is something that was explained to me by Henry Kissinger. So imagine a simple graph, and the vertical axis, the y-axis, is the probability of a certain outcome, and the x-axis is a timeline. Basically, you convert that into the amount of information you have. How much information do I have? How much time do I have to make a decision? Well, at zero, at the outset, you have no information, or very little. But you have a lot of time. You have a lot of degrees of freedom. But as you move across the x-axis, as you move down the timeline, what you discover is you get more and more information, which is a good thing. So that curve is going up, but you have less and less time, fewer degrees of freedom. That curve is going down. So when you get all the way to the other end, it's like, hey, I have perfect information, but it's too late. It's over. I missed either war started, or I lost all my money, or something bad happened. So what you look for is the sweet spot in the middle, call it the Kissinger cross, where I have enough information to be smart, but enough time to have degrees of freedom and be able to act. You look for that sweet spot in the middle, and that's when you act. And with a little humility is a very good tool, a good addition to the formula. So as I say, in the CIA, you never have enough information. You're always trying to get more, but you have to do the best you can, and kind of make assumptions and make forecasts, because you don't have the luxury of sitting back. You can't wait for 10 9/11 events so you can have a good statistical base. You got one, and you want to prevent the next one. Everything I just described is playing out, and there's data to back it up, not just an inverted treasury yield curve, which is interesting. Well, Tuesday 10 is the main sector where it's inverted, but even more profoundly in the Eurodollar futures curve. Yeah, I call the treasury yield curve a short-term bet on a long-term rate. The Eurodollar futures curve is a long-term bet on a short-term rate, because the Eurodollar future it's like we're betting on what an overnight rate is going to be 2 years from now. So okay, long-term bet on a short-term rate, and it's inverted, and it shouldn't be inverted. That should never, it does happen, but it should not happen. Yield curve should be upward sloping, just because time value of money and uncertainty, et cetera. If I lend to you for a longer period of time or make a further forward bet, I should get a higher rate. Well, how come people betting on overnight rates a year or 2 years from now think that rates are going to be lower? And that shouldn't happen. The only explanation for that is we're going to go into recession. It's going to get a lot worse. But going back to a really important distinction between a recession, even a bad one, and a financial crisis. because they're two different things. They can come together. But for example, in 1998, we had an acute financial crisis and with long-term capital management, and I negotiated that bailout. I had front row seat on that one. But 1994, the tequila crisis, and there was the bond market massacre. There have been these financial crises, but there was no recession in 1998. In fact, the NASDAQ went to the moon. We were looking, long-term capital, we were licking our wounds after the meltdown and, turning on CNBC and like watching pets.com, the sock puppet and all these things. They're going to the moon. Like, hey, we just got wiped out. But the opposite is true. You can have a recession without a financial panic. 1990, we had, kind of a mild recession. There was no financial panic then. 2020 was interesting. I don't know what to call it. I mean, technically a recession, but the economy drops 31% annualized. And they say 2 quarters, first and second quarter of 2020, but it was really 2 months. I mean, if you break it down, it was March and April. They happened to fall in 2 quarters and took both quarters negative, but it was really 2 months, down 31% in annualized in 2 months, and then up 35% by the third quarter. I mean, that was crazy. So maybe that's technically a recession. That's just what happens when you shut down the economy. But there was not a financial panic. Stock market fell, but the banks didn't fail. Nobody's lined up to take the money out of Citibank, et cetera. So you can have recessions without panics. You can have panics without recessions. October 19th, 1987, Dow falls 22% in one day. No recession. But sometimes they do go together. In 2008, they did. We had both. We had an honest to goodness financial panic. Everyone knows, Bear Stearns, Fannie Mae, Freddie Mac, Lehman, AIG. But I can tell you, and I've spoken to a lot of people, Morgan Stanley was days away. And then Goldman would have been behind that, probably Citi, and maybe JP Morgan would have been the last one. And the economy collapsed and the stock market fell well over 50%, I think 60%. So that was an example of both. And what I'm concerned about is we may be heading into both. If everything I said about what's behind the curtain, the plumbing of the financial system, acute dollar shortage, scramble for collateral, which leads to deleveraging, because if I can't get the collateral, I got to take the trade-off. Leveraging of balance sheets, et cetera, which are the early warning signs of a global financial panic, and a likely recession. We could very well be looking at a severe recession and a global liquidity crisis, 2 different things, but they could converge. You've got to give a little credit to Robert Shiller. He wrote a great book called Narrative Economics. Now, narrative is just a fancy word for a story. It's like, okay, you can call it a narrative, and it means a lot of people buy into it, but it just means there's a story that people believe. And this goes back to the greatest sociologist of the 20th century, Robert K. Merton. There is no Nobel Prize in sociology, but if there were, Robert K. Merton would have won it. But he's the one who came up with the phrase, the self-fulfilling prophecy. And the classic case is you wake up in the morning, the bank's fine, but somebody gets nervous and they run down and take all their money out. And somebody sees them and go, what are you doing? I say, I'm getting my money out of this bank. Okay, I better get my money out too. And everyone's like, I don't want to be the last one out. Next thing you know, there's a line around the block. And by the end of the day, the bank shuts its doors and they're bankrupt. But they weren't bankrupt at 9 o'clock in the morning. It's because a story spread. People believed it. People acted on it. And that's the key. Do you act on the story? You can make the thing you're worried about come true, even though it wasn't true when the story started. Narratives can be true, but they can be false. In other words, a completely false narrative can be extremely powerful if enough people buy into it. The Fed pivot is a narrative, and it went like this. So inflation takes everyone by surprise in fall, late 2021. November 2021, Jay Powell says, time to retire the word transitory. And then inflation goes to the roof. The stock market goes down. It's still going down. But then after the Fed raised rates, and then the yield curve is inverted, the narrative is like, well, wait a second. The yield curve inversion is telling us that rates are going to be lower months from now. Inflation's cooling off a little bit, and it has. And so they're going to have to cut rates. That was the pivot. And rate cuts are good for stocks, so buy stocks. But then we get this rally, and the stock market's, we're covering a lot of this, not all the lost ground, by the way, but a lot of it, all based on the Fed pivot narrative, which I never bought into. I mean, you don't want to stand in front of a moving train. I wasn't going to short the S&P. I did not buy into the narrative. I said for 2 reasons. Number one, inflation came down from 9. Well, that's nice, but you say you want to get it to 2. You're a long way from 2. And how much demand destruction, how many rate hikes, how much do you have to do to really destroy the economy to get inflation down to 2? The answer is a lot. And tell me why that's good for stocks. And it's not. But the other reason is, and this is a little more sophisticated analytically, but just because the yield curves are telling you that market pros think rates are going to be lower, doesn't mean the Fed's going to cut. That is the message, but it doesn't mean the Fed's going to get the message. How many times does the Fed get things right? The answer is never. The buy the dips crowd have not gone away. They're still around. I'll say talking heads, I guess I'm one, but the cheerleaders, I'll put it that way. The Wall Street cheerleaders have never gone away. The Wall Street always wants to sell you something. The people who think the Fed knows what they're doing, there's some of those. But the fundamentals have not changed. Forecasting the consequences of Fed policy is really difficult, but forecasting Fed policy is the easiest thing in the world because they tell you what they're going to do. But the hard part is what's going to happen as a result of that. And the Fed's thinking maybe hard landing, but not too bumpy. And I'm thinking more like a plane crash. Not to get too geeky, but sometimes I can't help myself. There's a concept, it's not that difficult. It's called DBO1, which is the dollar value of 1 basis point. And what it means is if interest rates go up, 25 basis points, what's the change in the price of securities? In other words, what's the rates up, prices down, rates down, prices up. That's just bond math, but it's not uniform or linear at all levels of rates. So when at higher rates, the DBO1 is lower, and at lower rates, the DBO1 is higher, which means the impact of every basis point increase in interest rates is greater at lower levels, right? So in other words, raising rates from, I'll just say 2 to 4 for a range is much more damaging to prices than going from 8 to 10. Much higher interest rates, a whole different world. But the impact of that on bond prices is less than going from 2 to 4, where it's like you're just putting these bonds in the cellar. And that plays out in derivatives world. So that's another factor, along with scarcity of collateral, shortage of dollars, quadrillion dollars in notional, deleveraging balance sheets, and a higher DBO1, meaning these interest rate hikes do more damage per basis point to bond prices than if they were at a higher level. That's definitely cause for concern. I don't match the company to the exact number, but layoffs on order of magnitude 10,000 to 20,000 terminated employees at Google, Amazon, Facebook, and other tech names. It affects other sectors as well, but tech in particular has engaged in a massive series of layoffs. And so people go, well, wait a second, how come that hasn't shown up in the unemployment numbers? Because the unemployment rate is it's around 3.5 on the exact numbers. We haven't seen that level of unemployment, that low, that is, since the 1960s. And the Fed is absolutely looking at that. And of course, they believe in the Phillips curve, which is junk science. But the Phillips curve, for those who are not familiar, says there's an inverse relationship between unemployment and inflation. So if unemployment is high, inflation is low. And if unemployment comes down, inflation goes up. And so if you want to get inflation down, you should expect to bring unemployment up. That's what the Fed believes. What I just said is nonsense. It's not true. If you think of a matrix of unemployment and inflation, what did we have in the late 1970s? We had high unemployment and high inflation. What did we have between 2009 and 2019? We had low unemployment and low inflation. What do we have now? Low unemployment and high inflation. So as you can fill in every box in the matrix, which means there's no correlation. I mean, you can describe it, you can calculate it, you can put it on a chart, but there's no correlation. Last time I looked at the Phillips curve, it was flat. At least where I went to school, curves were curved. So it's junk. But the Fed believes it. Again, it doesn't matter what I think. It matters what the Fed thinks. So you got to put yourself in their minds to figure it out. So as far as they're concerned, those kind of unemployment numbers, lowest since the 1960s, that's inflationary. They got to get those numbers up. Now, having said that, what else is the Fed missing? Well, wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah, so your real wage just went down. Because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake, but you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years. It runs around 5% annualized, give or take. Sounds like, hey, 5% raise, what do you want? Well, yeah, but your real wage is going down. So that's not a robust number at all. The Fed, by the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. It's all you do. It's not sophisticated. And that number today is around 61.2, give or take, percent. But as recently as 2000, that number was over 70%. And has come down ever since. And it dropped like a stone during 2020, during the pandemic lockdown. Came back a little bit, but not much. First of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population not working. You're a homemaker. You're a student. You're an early retiree. There's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low. And the trend has been down. So that leaves, relative to kind of a normalized number, that leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. And again, even if you allow for legitimate reasons for a lot of them, there's a big untapped labor pool. There are a lot of people who are sitting home watching, the football playoffs and not going to the unemployment office. That's the thing. You have to go to the unemployment office online or whatever. You have to at least look at a job to be counted as unemployed. If you're not looking, you're not counted as unemployed. But you're still a person. You're still capable of working. You're just not looking, which is a very negative sign, by the way. But if you took that group and threw it into the unemployment numbers, the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. That's a depression level of unemployment. The dollar, of course, it was, on a tear in 2021, most of 2022. It got to levels maybe technically not higher than 2000. Now, dollars come off a little bit, kind of starting in October, but I think that's about at the end of its adjustment, and the dollar's going to get stronger again. And the reason I say that is it's consistent with everything else we're talking about. If we're talking about the kind of recession that I've described, and if we're looking at the kind of yield curves, apart from the fact that it's reliable warning of recession, which it is, what's behind the curtain? What are the real reasons why the yield curve is inverted? It's sending a very bad signal. We interpreted the signal, but why? Why is it happening? The answer is there's a mad scramble for dollars. There is a serious dollar shortage, and people roll their eyes. They're like, wait a second, China's dumping treasuries, Brazil's dumping treasuries, people hate the dollar. China's talking to Saudi Arabia about paying for oil and yuan. What do you mean there's a dollar shortage? Well, there is. And we can see it, but there's a reason for it. 1 quadrillion is 1,000 trillion. That's approximately the notional value of all the derivatives, off-balance sheet derivatives of all the banks and hedge funds in the world. It's about 1 quadrillion. We're talking options, futures, swaps, swaptions, FX forwards, the whole thing, but they're all off balance sheet. So they don't show up in, conventional ratios. You got to read the footnotes and they don't tell you that much. So, okay, what supports that? How do you get a $1 quadrillion position, 1,000 trillion? Well, the answer is collateral, but not that much. It's a little sliver. It's kind of like 1% collateral under the 1 quadrillion. Okay. So in a credit crunch, you're going into recession, which is where we are. What do banks say to each other, and what do banks say to the hedge fund clients, et cetera, in terms of the quality of collateral? They say, I don't want your mortgages. I don't want your corporates. I don't even want 10-year treasury notes. I don't want 5-year treasury notes. I want treasury bills. That is the best, least volatile, most liquid, most creditworthy instrument in the world. And in a world where balance sheets are contracting, credit fears are rising, the economy's turning down, everyone's worried about this. Well, if you're Deutsche Bank or Barclays or HSBC or Unicredit or Banco Santander, you have a central bank that doesn't print dollars. ECB can print all the euros you want, doesn't print dollars. Where are you going to get the dollars? Well, if you want to buy dollar-denominated treasury bills, you got to get dollars so you can pay for them. That's what will drive the dollar higher. So they're desperate. They have to get dollars to prop up their own banks. If you're the People's Bank of China, you got to prop up the Chinese banking system. If you're the Swiss National Bank, you got to prop up Credit Suisse, et cetera. The Fed will actually give you all the treasury bills you want. All you have to do is just do a reverse repo with the Fed. You deposit your cash with the Fed, and they send you treasury bills, and it's like, can be overnight, 1 week, whatever. And at some point you unwind it. But what you usually do is just roll it over. So a phone call to the Fed will get you all the treasury bills you want. So why doesn't that solve the problem? The answer is the Fed bills cannot be rehypothecated. They can't be used the way the dealers want. They can't send them to Deutsche Bank. But if I buy the bills at auction, I can. And so there's a liquidity preference for buying treasury bills at auction because I can pledge them to somebody else, and that's what they do. But if I do the reverse repo, I got to hang on to them because the Fed won't let me rehypothecate. And so that's why the yield to maturity at auction is lower than what the Fed will give you for basically for free. But it's another one of these weird, quirky little inversions, but it tells you something. It tells you exactly what I said, which is there's a dollar shortage, and that will get worse as we go into a recession and credit losses pile up and banks get stressed and balance sheets get reduced and dealers say, it's treasury bills, give me a 4-week bill. That's going to drive the dollar higher against basically the euro.